They tell you diversification is for the wise. They tell you to spread your money thinly across dozens, even hundreds of stocks. They call it a free lunch. They say it's the only way to manage risk. And for 99% of people, for the 99% who are destined for average returns, for a life of just getting by, they are absolutely right. Timid diversification is a ticket to mediocrity. It's a guarantee that you will never get hurt badly, but it is also an ironclad promise that you will never, ever get rich. Real wealth, the kind of wealth that changes your family's trajectory for generations, the kind of wealth that buys you freedom, is not built by spreading your bets. It is built by concentrating them. It is forged in the fires of high conviction, by finding a rare moment when the odds are overwhelmingly stacked in your favor, and then having the courage, the sheer guts to bet big. This isn't about reckless gambling. This is about a profound and deeply intelligent form of risk management that the financial industry doesn't want you to understand, because a diversified public is a profitable public for them. What you are about to learn is the mental framework of the true capital allocator, the secret that separates the Warren Buffetts of the world from the everyday investor. It is the principle of intelligent concentration, and it is the only reliable path to life-changing wealth. We begin with the bedrock, the absolute non-negotiable foundation upon which all concentrated investing is built. It's a concept so simple it sounds almost insulting, yet its mastery is what separates the professional from the amateur, the wealthy from the hopeful. It is the circle of competence. You cannot make a large, high-conviction bet if you do not know with absolute certainty that you are playing a game you can win. You must know the rules, the players, and the odds better than anyone else at the table. To bet big outside of your expertise isn't courage, it's lunacy. Warren Buffett's career is a masterclass in this discipline, but one story, in particular, crystallizes the principle perfectly. It's the story of a small, family-owned candy company that would teach Buffett one of the most important lessons of his life. The year was 1972. Berkshire Hathaway was still primarily a textile company, but Buffett and his partner Charlie Munger were using its cash flow to acquire other businesses. They were presented with an opportunity to buy a company called See's Candies. On the surface, it looked expensive. See's was projected to earn about $2 million after tax that year, and the sellers, the See family, were asking for $30 million. They eventually negotiated it down to $25 million. Now, for the Buffett of that era, a devoted student of Benjamin Graham, this was a steep price. Graham had taught him to buy businesses for pennies on the dollar, to look for cigar butts on the ground. Mediocre companies with one last puff of profit left in them that you could get for a ridiculously cheap price. See's Candies was no cigar butt. A price of $25 million for a company earning $2 million was a multiple of over 12. This was growth investing, something that made the value investor in Buffett deeply uncomfortable. Berkshire's entire net worth at the time was only about $80 million. This one single investment would represent a significant portion of their capital. It was a concentrated bet. But here is where the circle of competence came into play. Buffett and Munger didn't understand complex technology. They didn't understand international arbitrage. But they understood candy. They understood the power of a brand. They understood the simple, beautiful economics of a business that people loved. They did their homework. They saw that See's had immense pricing power. Year after year, the company could raise its prices slightly, and its loyal customers wouldn't even blink. They would happily pay a little more for the same box of chocolates they gave their mothers on Mother's Day or their sweethearts on Valentine's Day. This brand loyalty was a powerful, unbreachable moat around the business. It wasn't on the balance sheet, but it was the most valuable asset the company owned. They realized that See's didn't require much new capital to grow. It was a cash-generating machine. The profits it spun off could be used to buy other businesses without needing to be reinvested into new candy factories or expensive equipment. They understood the psychology of the customer, the emotional connection to the product. They knew that when a man went to buy a gift for his wife, he wasn't going to risk saving $1 on a generic brand and potentially ruin the occasion. He would pay the premium for the trusted, beloved See's name. Because they understood all of this, because the business was squarely within their circle of competence. The high price tag became rational. They weren't buying $2 million in annual earnings. They were buying a perpetual royalty on human emotion and habit. They paid the $25 million. That single, concentrated bet has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that required almost no additional capital investment. It was the engine that funded countless other acquisitions. It was a bet that was only possible because they knew the game they were playing. They weren't speculating, they were investing from a position of near certainty. This story reveals a profound psychological truth that governs the world of investing. The principle at play here is a direct counterassault on one of the most pervasive and dangerous cognitive biases, the Dunning-Kruger effect. The Dunning-Kruger effect is a type of cognitive bias in which people with low ability at a task overestimate their ability. It's the mountain of stupid that every investor must climb before they can even begin to achieve competence. You see it everywhere. The guy who just opened a Robinhood account and made money on a meme stock now thinks he's a Wall Street genius. The amateur who reads a few articles about artificial intelligence and then dumps his life savings into a speculative AI company he doesn't remotely understand. They confuse familiarity with expertise. They use an iPhone, so they think they understand Apple's global supply chain, its semiconductor strategy, and the competitive landscape of the smartphone market. They don't. This illusion of knowledge is the siren song that leads portfolios onto the rocks. Warren Buffett's superpower is not his IQ. It is his radical and brutal self-awareness. He is perhaps the world's most successful practitioner of intellectual humility. He has a simple filing system in his office with 3 trays: in, out, and too hard. The too hard pile is, by far, the largest. It's filled with industries and companies that, by his own admission, he simply does not understand well enough to predict their future 10 or 20 years from now. Complex pharmaceuticals, cutting-edge technology, volatile commodity businesses, they all go into the too hard pile. There is no shame in it. In fact, it is the source of his strength. By clearly defining the boundaries of his knowledge, he protects himself from making catastrophic errors. He knows where his informational and analytical edge exists, and he refuses to play in any other sandbox. The average investor does the opposite. Their ego, fueled by the Dunning-Kruger effect, tells them they can be a jack of all trades. They feel they need to have an opinion on every hot stock, every new trend. This leads to a portfolio that is a scattered, incoherent collection of bets made on half-baked ideas and media hype. A concentrated portfolio strategy is impossible without first acknowledging this psychological flaw. You can only bet big when you have done the work to move from a state of unconscious incompetence, where you don't even know what you don't know, to conscious competence. That is the state where you understand a business so deeply that you see its future with a clarity that the market, in its manic depressive swings, simply cannot. This deep understanding is the only thing that provides the psychological fortitude, the raw conviction, to buy more when the price goes down and to hold on for decades while the value compounds. Without it, a concentrated bet is just a high-stakes gamble. So how do you, as an aspiring investor or entrepreneur, apply this? How do you build your own circle of competence and use it as the foundation for a high-conviction investing strategy? It's not an academic exercise. It is a practical, step-by-step blueprint for building an unshakable investing foundation. First, you must conduct a ruthless personal inventory. Get a piece of paper or open a document and create 2 columns: Professional Edge and Passionate Hobbyist Edge. In the Professional Edge column, write down the industry you have worked in for years. What are the earned secrets of your trade that an outsider wouldn't know? Do you work in insurance? You probably understand risk and float better than 99% of investors. Do you work in retail? You understand inventory management, supply chains, and consumer trends. This is your most fertile ground for finding opportunities. You have an existing, unfair advantage. In the Passionate Hobbyist column, list the areas where you spend your free time reading and learning for fun. Are you obsessed with video games? You might have a better grasp of the gaming industry's competitive landscape than a Wall Street analyst who is just looking at spreadsheets. Are you a homebrewing fanatic? You might understand the economics of craft breweries. The key is that your knowledge must be deep, not wide. The goal is not to have a dozen areas of mild interest, but one or two areas of profound expertise. Second, you must embrace the too hard pile. This is an act of intellectual liberation. Consciously decide which industries you will simply ignore. For most people, this should include things like biotechnology, complex financial derivatives, and most speculative technology. If you cannot explain in simple terms how a company makes money and why it will continue to do so for the next decade, it goes into the pile. No exceptions. This isn't a sign of weakness. It's a sign of professional discipline. It frees up your mental energy to focus only on the pitches that are in your sweet spot. Third, apply the inversion test to any potential investment within your circle. Instead of asking, "How can this investment succeed?" ask the opposite. What would it take to kill this business? If you were a competitor with unlimited capital, how would you attack it? What are its weakest points? If you cannot answer this question in terrifying detail, you do not understand the business's competitive moat well enough to make a concentrated bet on it. You need to understand the bear case even better than the bears do. Finally, use the 5-year-old explanation test. Before you invest a single dollar, try to explain the investment thesis to an intelligent friend who knows nothing about the industry, or even imagine explaining it to a child. I am buying shares in this company because it sells a product that people are addicted to, and it can raise the price every year without losing customers. This means its profits will keep going up and up. If your explanation involves jargon, complex financial terms, or vague hopes about future technology, you're not ready. A truly great investment idea is simple and powerful. By following this blueprint, you are not just picking stocks, you are defining your battlefield. You are choosing to play a game where you have a structural advantage, which is the prerequisite for the kind of high-conviction investing that builds real, life-changing wealth. Now let's look at the dark side. What happens when you ignore this fundamental pillar? You end up on the path of the 99%, the path of the consensus investor who is perpetually chasing ghosts. The antithesis of operating within a circle of competence is the story stock investor. This person doesn't invest in businesses, they invest in exciting narratives. They are seduced by tales of disruption, paradigm shifts, and futuristic technologies they barely comprehend. The dot-com bubble of the late 1990s was the ultimate monument to this folly. Millions of ordinary people, from dentists to teachers, suddenly believed they were venture capitalists. They poured their life savings into companies with .com in their names. No profits, no revenues, and in many cases, no viable business plan. They were betting on a story, a dream of a new economy, where the old rules of value no longer applied. They were operating so far outside their circle of competence that they couldn't even see the shore. They didn't understand the technology. They didn't understand the competitive landscape. They couldn't value the businesses because there was nothing to value. They were simply gambling on a ticker symbol going up. The results were catastrophic. When the bubble burst, trillions of dollars in paper wealth evaporated. Retirement dreams were shattered. It was a brutal, global-scale lesson in the importance of sticking to what you know. This pattern repeats itself in every market cycle. In recent years, we've seen it in cryptocurrency, in cannabis stocks, in electric vehicle startups that have never produced a car. The story is always alluring. It's always about getting in on the ground floor of the next big thing. The 99% investor confuses being a user of a product with being an expert on the business. They use Uber, so they buy Uber stock without a deep analysis of its labor costs, regulatory hurdles, or path to profitability. They are excited about space travel, so they buy Virgin Galactic stock without understanding the immense capital expenditures and technological risks involved. This leads to a portfolio built on sand. When the narrative shifts, when the market sentiment turns, there is no underlying foundation of knowledge to give them conviction. They don't know if the 20% drop in their favorite tech stock is a buying opportunity or the beginning of the end, because they never understood the business in the first place. So they panic. They sell at the bottom, locking in their losses, and then watch in agony as the stock recovers later. This cycle of buying high on hype and selling low on fear is the direct result of straying from one circle of competence. It is the guaranteed path to poor returns and immense frustration. How does this rigorous discipline of staying within your circle translate into a direct, quantifiable financial advantage? It is not an abstract philosophical concept. It is a powerful engine for superior capital allocation and wealth management. First and foremost, it drastically reduces the rate of unforced errors. In investing, what you don't see is often more important than what you do. By having a well-defined too-hard pile, you eliminate the possibility of losing a significant portion of your capital on a speculative bet you never should have made in the first place. Preventing one or two catastrophic losses of 50% or more has a more powerful positive effect on your long-term compounding rate than picking a dozen mediocre winners. A 50% loss requires a 100% gain just to get back to even. The math of avoiding big mistakes is brutally in your favor. Second, when you operate within your circle, your ability to analyze and value a business is magnified. You can assess its competitive advantages, its management quality, and its future earnings power with a clarity that the general market lacks. This allows you to act with supreme confidence when an opportunity arises. When a great business within your area of expertise goes on sale due to a market panic or a temporary setback, you don't hesitate. You recognize it for the gift that it is. This is what allows for a concentrated portfolio strategy. You don't need to own 50 stocks if you can find 3 to 5 phenomenal businesses that you understand inside and out. This clarity provides the conviction to make a large bet, which is the only way to generate returns that are significantly above average. A portfolio of 5 great ideas you understand deeply will always outperform a portfolio of 50 mediocre ideas you barely know. This approach directly leads to higher long-term capital gains. By buying and holding businesses you understand, you let them compound for years, even decades, deferring taxes and allowing the growth engine of the business to do the heavy lifting. Your portfolio's performance becomes a reflection of the underlying business performance, not the manic whims of the market. This is the CEO mindset applied to personal finance. A CEO doesn't run 50 different businesses. They focus their energy and capital on one enterprise they know intimately. Your journey to financial freedom requires the same focused, expert-driven approach to your own capital allocation. The circle of competence isn't a restriction, it's your ultimate weapon. It is the floodlight that illuminates the rare, high-probability opportunities and gives you the courage to seize them. Once you have defined your circle of competence, you have earned the right to look for opportunities. But not just any opportunity will do. For a concentrated bet to be rational, the odds must be overwhelmingly in your favor. This brings us to the second great pillar of Buffett's philosophy, the margin of safety. This concept, borrowed from his mentor Benjamin Graham, is the single most powerful principle for risk management in investing. It is the art of stacking the deck in your favor before the cards are even dealt. It means buying something for substantially less than you believe it is worth. It is building a bridge that can hold a 30,000-pound truck, but only ever driving a 10,000-pound truck across it. It is the buffer that protects you from bad luck, from unforeseen events, and most importantly, from your own errors in judgment. The most dramatic example of Buffett employing this principle came early in his career, during an event known as the Salad Oil Scandal. The year was 1963. A company called Allied Crude Vegetable Oil, a major customer of American Express's warehousing division, defaulted on its loans. The reason was shocking. The company had been perpetrating a massive fraud. Its giant vats, which were supposed to be full of valuable salad oil securing the loans, were mostly filled with seawater, with only a thin layer of oil floating on top. When the fraud was discovered, panic erupted. Wall Street feared that American Express would be on the hook for the massive losses of the banks that had lent money against the fraudulent collateral. The liability could potentially bankrupt the company. The stock price of American Express was annihilated, plunging by nearly 50%. The herd was selling in a blind panic. This is where Buffett, the master of rational thought, saw not a crisis, but an opportunity. Instead of reading hysterical newspaper headlines, he did his own primary research. He left his office and started visiting restaurants and banks. He talked to merchants. He talked to tellers. What he observed was that the scandal, while dramatic, had absolutely no effect on American Express's core businesses. People were still using their American Express cards. Travelers were still buying and using their travelers' checks. The brand, the trust, the fundamental business model was completely intact. The market was confusing a problem in a small, non-essential division with a mortal wound to the entire enterprise. He calculated that the company's core businesses were worth far more than the current panic-driven stock price, even if they had to pay out every single dollar of liability from the scandal. He had found an enormous margin of safety. The market was offering him a dollar bill for 50 cents, maybe even 40 cents. So what did he do? He didn't just nibble. He bet the farm. He invested 40% of his entire investment partnership's capital into American Express stock. It was a massive, concentrated bet. It was a career-defining moment. And, of course, he was right. As the panic subsided and the true, limited nature of the liability became clear, the stock price soared. He made a fortune for his partners. This wasn't luck. It was the result of a disciplined process. Wait for a great business, you understand. Wait for it to be offered at a price that is deeply irrational due to fear or pessimism, and then bet heavily. The margin of safety was his courage. It was the mathematical and logical foundation that allowed him to act decisively while everyone else was paralyzed by fear. The salad oil scandal is a perfect illustration of how Buffett overrides two of the most powerful and destructive psychological biases in finance: loss aversion and myopic risk aversion. Loss aversion is the well-documented tendency for humans to feel the pain of a loss roughly twice as strongly as the pleasure of an equivalent gain. Losing $100 hurts more than finding $100 feels good. This hardwired instinct is a survival mechanism from our evolutionary past. It was better to be terrified of the rustle in the bushes that might be a tiger than to be complacent. But in modern financial markets, this instinct is a catastrophic liability. It is the force that causes investors to panic sell after a stock has already fallen, turning a temporary paper loss into a permanent, devastating loss of capital. They sell not because their analysis of the business has changed, but because the emotional pain of seeing their account balance in the red becomes unbearable. Myopic risk aversion is a related concept. It describes our tendency to focus on the short-term volatility of our investments rather than their long-term potential. We check our portfolios daily, hourly even, and every downward tick feels like a threat. This constant stream of negative feedback triggers our loss aversion, leading to poor, short-sighted decisions. Buffett's entire framework is designed to neutralize these biases. The margin of safety is the ultimate antidote. When you buy a stock at 50 cents on the dollar, you are psychologically reframing the situation. You are not buying a falling stock, which triggers fear. You are seizing a bargain, which triggers a sense of satisfaction and cleverness. You have anchored your mindset to the intrinsic value of the business, not its fluctuating daily price. During the American Express crisis, the average investor saw the stock price plummeting, and their loss aversion screamed, "Get out! Sell before it goes to zero." Buffett, armed with his margin of safety, saw the gap between price and value widening, and his rational brain said, "This is the opportunity of a lifetime. Buy more." He is able to zoom out and ignore the myopic short-term noise because his focus is on the value of the business over the next 5 to 10 years. He knows that market panics are temporary, but the earning power of a great business is durable. By insisting on a massive discount, he creates a psychological as well as a financial buffer. It's a pre-commitment to rationality. It allows him to be greedy when others are fearful, not because he is a reckless cowboy, but because he has done the work to ensure that the odds are monumentally in his favor. He has transformed a terrifying situation into a mathematically sound, high-probability bet. This mental mastery over primal fear is what separates the masters of capital allocation from the masses. So how do you systematically build a margin of safety into your own investment process? It requires discipline and a simple but powerful mental model. This is the blueprint for buying assets like a professional, ensuring that every major investment you make has a built-in cushion against the unpredictable nature of the world. First, you must learn to perform a basic intrinsic value calculation. Don't be intimidated by this. You don't need a complex Wall Street spreadsheet. The goal, as Buffett says, is to be approximately right, not precisely wrong. A simple approach is a discounted cash flow analysis. Step 1. Estimate the amount of cash the business can generate for its owners over the next 10 years. Be conservative. Step 2. Choose a reasonable discount rate, which is the return you would demand for taking on the risk of owning the business, perhaps 10%. Step 3. Calculate the present value of those future cash flows. That number is a rough estimate of the company's intrinsic value. The specific number is less important than the process of thinking through the drivers of the business's long-term earning power. Second, you must apply the non-negotiable 50-cent dollar rule. Once you have your conservative estimate of intrinsic value, you simply wait. You do not buy the stock unless the market offers it to you for a significant discount to that value. A 30% discount is good. A 50% discount is a signal to act decisively. This rule is your defense against an uncertain future and your own analytical errors. If your valuation is off by 10 or 20%, the margin of safety still protects your capital. Third, you must stress test the business. Before you invest, act as a pre-mortem devil's advocate. Ask the brutal questions. What happens if a major recession hits tomorrow? What if the company's largest customer goes bankrupt? What if their raw material costs double? A true margin of safety exists only when the business is robust enough to withstand severe shocks. A highly leveraged company or a company with a single point of failure may look cheap, but it lacks the resilience to offer a genuine margin of safety. Finally, you must identify the source of the discount. Why is the market offering you this bargain? Is it a temporary, solvable problem like the American Express scandal? Is it a general market panic where investors are selling everything indiscriminately? Or is it a fundamental, permanent impairment of the business? Understanding why something is cheap is the key to distinguishing a true opportunity from a value trap. A company that is cheap for a very good reason. By rigorously applying this four-step blueprint, you shift the investing game from one of speculation to one of probability. You are no longer hoping the price goes up. You are investing on the basis of a quantifiable gap between price and value. This is the intellectual foundation required for high-conviction investing. It gives you the logical reason to stand apart from the crowd and make a significant financial commitment when the opportunity is truly exceptional. Let's contrast this disciplined approach with the path of the 99%, the path of the momentum chaser. This investor represents the polar opposite of the margin of safety principle. They are not concerned with intrinsic value. Their only metric is price action. They buy stocks because they are going up, and they sell them because they are going down. Their philosophy is to ride the trend. They are drawn to the most popular, most hyped stocks, the ones with the most exciting stories and the most parabolic price charts. They buy at the peak of euphoria, paying a premium for the privilege of joining the party late. They have no margin of safety. In fact, they have a margin of danger. They are buying a dollar bill for $2, hoping to sell it to an even greater fool for $3. This strategy can work for a while, as long as the music is playing and the crowd remains euphoric. But it is a game of musical chairs with catastrophic consequences when the music inevitably stops. We saw this with the Nifty 50 stocks in the 1970s, great companies like Coca-Cola and Polaroid that were bid up to absurd valuations because the consensus was that you, quote, couldn't overpay for quality. Investors who bought at the peak saw their investments lose over 50% of their value, and it took them more than a decade just to break even. We saw it again with the dot-com bubble, and we see it in every cycle with the market's darlings. The momentum chaser has no anchor in reality. Their conviction is entirely dependent on the stock price continuing to rise. The moment it turns, their entire thesis evaporates. A 10% dip isn't a potential opportunity. It's a terrifying signal that the trend is broken. Since they have no concept of the business's intrinsic value, they have no logical reason to hold on, let alone buy more. So they sell, often to the value investor who has been patiently waiting on the sidelines for just such a moment. The momentum chaser confuses a rising price with a good business and a falling price with a bad one. They are constantly whipsawed by the market's moods, buying at the point of maximum risk and selling at the point of maximum opportunity. Theirs is a strategy built on hope and the psychology of the crowd, while the margin of safety investor builds their strategy on arithmetic and the durable economics of the underlying business. The path of the 99% is a frantic, anxiety-ridden sprint that ultimately leads to exhaustion and financial disappointment. The direct financial connection of the margin of safety principle is profound and twofold. It provides both powerful downside protection and explosive upside potential. This combination is the holy grail of capital allocation and the key to long-term stock market wealth. First, let's consider the downside protection. By buying a business for significantly less than it's worth, you are preloading your investment with a buffer. If you are wrong about the company's future growth, if a recession is worse than expected, or if unforeseen competition emerges, the margin of safety acts as a financial shock absorber. The business doesn't have to perform spectacularly for you to avoid a permanent loss of capital. It just has to perform adequately. This dramatically changes the risk profile of your portfolio. You are systematically eliminating the chances of a catastrophic blow-up, which, as we've discussed, is the most important factor in long-term compounding. This is the intelligent form of risk management, far superior to the timid diversification of owning 100 stocks you know nothing about. Second, and more excitingly, is the upside potential. The margin of safety creates a powerful coiled spring effect. When you buy a great business at a panicked price, you have two forces that will drive your returns. The first is the normal growth of the business itself, its increasing earnings and dividends. The second is the closing of the gap between the market price and the intrinsic value. As the panic subsides and the market recognizes its error, the stock price will often snap back violently toward its true worth. This re-rating by the market can happen much faster than the underlying business growth, providing a massive front-loaded boost to your capital gains. This is how multi-bagger returns are generated. You buy American Express when the market thinks it's going bankrupt, and you benefit not only from its continued business success, but from the market eventually realizing it was wrong. This dual-engine return, from both business performance and market re-evaluation, is what turns a concentrated bet into a life-changing wealth event. It transforms the risk-reward equation from a symmetrical coin flip into a lopsided bet, where, in the words of investor Mohnish Pabrai, it's heads I win, tails I don't lose much. That is the ultimate financial advantage, and it is only available to those who have the discipline to demand a margin of safety. You've defined your circle of competence. You've armed yourself with the principle of margin of safety. You know what you're looking for. Now comes the hardest part for most people: doing nothing. The third pillar of intelligent concentration is patience and inactivity. The stock market is a hyperactive, noisy casino designed to lure you into constant action. But true wealth is built by recognizing that exceptional opportunities are rare. They do not come along every day or every week. They may only come along a few times a year, or even a few times a decade. The skill lies in developing the emotional discipline to conserve your capital and your mental energy, sitting patiently on the sidelines until one of those rare, fat-pitch opportunities appears right in your sweet spot. Warren Buffett has a brilliant analogy for this. He tells aspiring investors to imagine they have a punch card with only 20 slots on it. That's 20 investments for their entire life, Every time they make an investment, they have to punch a hole in the card. With this constraint, would you really waste a punch on your 50th best idea? Of course not. You would wait and wait and wait for an absolute certainty, a no-brainer. You would do obsessive research. You would demand a massive margin of safety, and you would make a significant bet. This mental model forces a level of discipline and selectivity that is almost unheard of in the world of finance. It turns investing from a frantic game of musical chairs into a patient safari, where you wait silently in the blind for the magnificent prize-winning animal to wander into your sights. The history of Berkshire Hathaway is a testament to this principle. There have been long, multi-year periods where Buffett and Munger did almost nothing. They allowed cash to pile up on Berkshire's balance sheet, sometimes reaching tens of billions, even over $100 billion. During the euphoric peaks of market cycles, like in the late 90s or in the years leading up to 2008, Wall Street analysts and the financial media ridiculed them. They said Buffett had lost his touch. They said he was too old, too out of sync with the new economy. But Buffett wasn't trying to time the market. He was simply being a disciplined shopper. He looked at the prices of businesses and saw nothing that met his strict criteria of a great company at a sensible price. So his default action was to do nothing. He was waiting for the fat pitch. And when did that pitch come? It came in the fall of 2008, at the absolute peak of the global financial crisis. The world was on the brink of collapse. Lehman Brothers had just gone bankrupt. Credit markets were frozen solid. Fear was palpable. And what was Warren Buffett doing? He was on the phone, putting his massive pile of cash to work. He made legendary deals, investing billions in companies like Goldman Sachs and Bank of America on terms that were so favorable, so one-sided, that they were only possible because he was the only one with both the cash and the courage to act. His patience had armed him with the ultimate strategic asset, liquidity in a time of crisis. He had waited for the perfect pitch, and when it came over the plate, he swung for the fences. That is the power of inactivity. The psychological principle that Buffett's patience so elegantly crushes is known as action bias. Humans are hardwired for action. In our evolutionary past, when faced with a threat or an opportunity, the individual who acted quickly was more likely to survive and reproduce than the one who sat and contemplated. This instinct is embedded deep within our brains. We believe that doing something is always better than doing nothing. In many areas of life, this is a useful trait. But in investing, it is pure poison. Action bias is the engine that powers the entire financial media and brokerage industry. They need you to be constantly doing something, buying, selling, trading, because that's how they generate commissions and clicks. The constant stream of breaking news, analyst upgrades and downgrades, and minute-by-minute market updates is all designed to trigger your action bias, to make you feel that you must react to every piece of new information. It creates a sense of FOMO, the fear of missing out. The hyperactive trader is the ultimate victim of this bias. They are glued to their screens, mistaking the flurry of activity for progress. They overtrade, racking up transaction costs and taxes. They buy a stock, and if it doesn't go up immediately, they get bored or anxious and sell it, often just before it makes its big move. They are never able to sit still long enough to let a great business idea truly compound into life-changing wealth. Buffett's ability to sit patiently, sometimes for years, with a growing pile of cash is his rebellion against action bias. He understands that the market is a servant, not a guide. It is there to present you with opportunities, not to command you to act. He has cultivated a state of what could be called active patience. He is not idle. He is constantly reading, learning, and analyzing businesses. He is preparing himself so that when the rare opportunity does finally appear, he is ready to act with lightning speed and overwhelming force. But until that moment arrives, his default setting is a resolute no. This temperament, this ability to be content doing nothing, is perhaps the rarest and most valuable trait in an investor. It is a psychological superpower that allows him to conserve his resources for the few battles that will actually determine the outcome of the war. Most investors exhaust themselves in 1,000 meaningless skirmishes. Buffett wins by choosing his battles with extraordinary care. So how do you cultivate this rare skill of patient inactivity? How do you build a system that protects you from your own ingrained action bias? This blueprint is about creating a structure for patience, turning it from a vague virtue into a concrete, actionable strategy. First, you must adopt the no called strikes rule of investing. Think of yourself as a batter in a baseball game where the umpire never calls a strike. You can stand at the plate all day and watch thousands upon thousands of pitches go by. Bad pitches, mediocre pitches, pitches that are just slightly off-center. You face no penalty for letting them pass. Your one and only job is to wait until the pitcher grooves a fat pitch, a perfect, slow, hittable ball right down the middle of the plate. In investing, the pitches are the thousands of publicly traded companies. Most of them are not for you. You only need to swing a few times in your life to be incredibly successful, but each swing must be at a pitch you are absolutely certain you can hit out of the park. Second, create a watch list of greats. This is your active patience in practice. Identify 10 to 15 truly wonderful businesses that fall within your circle of competence. These are companies with durable competitive moats, excellent management, and strong balance sheets. The problem is, they are almost always expensive. So you do the work. You calculate a conservative intrinsic value for each one. Then, you determine your buy price, the price at which you would be getting a significant margin of safety. You put this list aside, and you watch. You might watch for months or even years, but you are prepared. When a market panic or a company-specific issue causes one of your great businesses to fall to your buy price, you don't need to start your research from scratch. You have already done the work. You are ready to act. Third, implement the cash wedge strategy. View cash not as a zero-yielding anchor on your portfolio, but as a strategic asset. It is your dry powder, your call option on future market panic. Intentionally, keep a portion of your potential investment capital, perhaps 10 to 25%, in cash or short-term treasuries. This cash isn't sitting idle, it's waiting for deployment. It gives you the ability to be the buyer of last resort when everyone else is a forced seller. It's the source of your power during a crisis. Finally, schedule a do-nothing review of your portfolio. Instead of constantly checking your stocks, set a specific time, perhaps once a quarter, to review your holdings. Your default decision during this review should be to do absolutely nothing. To justify a change, to sell a stock or buy a new one, the evidence must be overwhelming and new. This simple structural change shifts the burden of proof from inaction to action, helping to short-circuit your brain's natural tendency to tinker. By implementing this system, you are building a fortress against your own worst emotional impulses. You are creating a framework where patience is the default, and decisive action is the rare, well-considered exception. The antithesis of the patient allocator is the hyperactive trader, the quintessential member of the 99%. This individual lives in a state of perpetual anxiety and reactivity. Their investment philosophy is shaped by the daily noise of the financial media. They wake up and immediately check stock futures. They have CNBC on in the background all day. They have alerts set on their phone for every twitch and tremor in their portfolio. They mistake this constant engagement, this fire hose of information, for being an informed investor. In reality, they are simply a well-marinated victim of action bias. Their portfolio is a revolving door. They hear a positive story about a company and they buy it. A week later, a negative analyst report comes out and they sell it. They chase performance, buying stocks only after they have already made a huge upward move. They get shaken out by normal market volatility, selling a great long-term holding because of a 10% correction. Their portfolio's performance is a slow bleed, a death by 1,000 cuts from commissions, taxes, and poor timing. They are always busy, but they are never making progress. They are running on a hamster wheel, mistaking the frantic motion for forward momentum. The crucial element they miss is that a great business needs time to work its magic. The true power of investing comes from the miracle of compounding, and compounding requires long, uninterrupted stretches of time. By constantly trading, the hyperactive investor is forever pulling up his seedlings to see if the roots are growing. He never gives a great idea the chance to mature into a mighty oak of wealth. He is playing the market's game, a game of speed and noise, designed to enrich the brokers and the market makers. The patient investor, in contrast, is playing their own game, a game of value and time, designed to enrich themselves and their family. The path of the 99% is a whirlwind of activity that ultimately leads to average, or more often, below average results. It is a perfect demonstration of the old Wall Street adage, the stock market is a device for transferring money from the active to the patient. The direct financial connection of a patient-inactive approach is one of the most powerful but least appreciated forces in wealth creation. It impacts your bottom line in three crucial ways. First, and most simply, it minimizes transaction costs. Every time you buy or sell a stock, you are paying a commission, however small. More importantly, you are crossing a bid-ask spread, which is a hidden cost. For the hyperactive trader, these small costs add up over a year to a significant drag on performance, a constant headwind that must be overcome just to break even. Patient, long-term investors largely eliminate this drag. Second, and far more significantly, is the impact on taxes. In the United States and most other countries, there is a massive tax advantage for long-term investors. Investments held for more than a year are typically taxed at a much lower long-term capital gains rate. Short-term trades are taxed as ordinary income, which can be more than double the long-term rate. By simply holding on to your winners, you are allowing the government's share of your profits to continue compounding for your benefit. Hyperactive trading is a form of voluntary accelerated taxation. It is a guaranteed way to give a larger share of your returns to the taxman. The greatest financial benefit, however, is that a patient strategy is the only way to truly capture the explosive, asymmetric returns that a great business can generate over time. A company that grows its earnings by 15% a year will double in value in 5 years and be a 10-bagger in about 17 years. But you have to be there for the journey. You have to hold on through recessions, market crashes, and periods of doubt. The patient investor who buys a great company and holds it for a decade or two can experience these life-altering returns. The active trader who jumps in and out might capture a small piece of the move here and there, but they will never experience the full, explosive power of long-term business compounding. Patience, therefore, is not a passive virtue. It is an active financial strategy. It is a conscious decision to optimize for low costs, low taxes, and the full, unadulterated power of compound growth. It is the capital allocation strategy that truly enables financial freedom. Now we arrive at a crucial shift in perspective. To have the conviction to make a large, concentrated bet and the patience to hold it for the long term, you must undergo a fundamental mental transformation. You must move beyond thinking like a stock trader and start thinking like an owner. This is the fourth pillar, the owner's mindset. You must see stocks not as blinking ticker symbols on a screen, but as fractional ownership stakes in real, living, breathing businesses. You are not playing the market. You are becoming a silent partner in an enterprise. This mindset is the ultimate source of conviction. It is what anchors you to the business's reality during the market's bouts of insanity. No story better illustrates this than Buffett's acquisition of the Nebraska Furniture Mart in 1983. This was not a stock purchase. It was the purchase of an entire private business. The company was founded by an indomitable Russian immigrant named Rose Blumkin, known to everyone as Mrs. B. She had built the largest furniture store in Omaha from scratch, with a simple, ruthless philosophy: sell cheap and tell the truth. Buffett had observed her business for years and was in awe of its competitive moat. It was not a brand or a patent, it was Mrs. B herself. Her obsession with low costs and customer satisfaction was legendary. Competitors simply could not match her prices or her drive. In 1983, at the age of 89, she decided to sell. Buffett went to see her. He asked her what her business was worth. She told him $60 million. He asked to see her financials. She told him her books weren't audited. He didn't care. Based on his understanding of the business and his trust in her as an operator, he wrote her a check for $60 million right then and there. It was a one-page contract, a handshake deal. He didn't do months of due diligence. He didn't hire a team of investment bankers. Why? Because he was thinking like a business owner, not a stock analyst. He knew he wasn't buying a collection of assets on a balance sheet. He was buying a powerful, durable earnings machine run by a brilliant manager. He understood the business so intimately that the formalities were secondary. He knew that as long as Mrs. B was at the helm, the business would continue to be a gusher of cash. He bought the entire company, and then he let her keep running it. The Nebraska Furniture Mart went on to become a multi-billion-dollar enterprise, one of the crown jewels of Berkshire Hathaway. This is the owner's mindset in its purest form. When you buy a stock, you should apply the same logic. You are buying a small piece of a Nebraska Furniture Mart. Your focus should be on the quality of the business and its management, not on the daily gyrations of its stock price. This owner's mindset is a powerful psychological tool that directly counteracts some of the most common behavioral biases that plague investors. The first is the endowment effect, our tendency to place a higher value on things we own simply because we own them. Buffett weaponizes this. By truly thinking of himself as a part owner of Coca-Cola or American Express, he becomes deeply attached to the underlying business. This creates a powerful inertia against selling. He doesn't want to sell his business unless something has fundamentally and permanently changed for the worse. The average investor, in contrast, often suffers from a lack of this effect. They see their stocks as temporary holdings, like renting a car. There's no deep sense of ownership, so it's easy to sell on a whim. The second bias this mindset helps to overcome is mental accounting. This is our tendency to compartmentalize our money into different mental buckets. People will have safe money in their savings account, which they treat with great care, and play money, or stock market money, which they are willing to gamble with recklessly. This is irrational. A dollar is a dollar. The owner's mindset destroys this distinction. When you see your portfolio not as a collection of stocks but as ownership stakes in real businesses, the money becomes very, very real. You are not risking market money. You are risking your share of a real factory, a real brand, a real retail operation. This forces a level of seriousness and diligence that is absent in the ticker watcher. The stock price becomes what Buffett calls it, Mr. Market. He imagines a manic-depressive business partner who shows up every day and offers to either buy your share of the business or sell you his. Some days, Mr. Market is euphoric and offers you a ridiculously high price. Other days, he is despondent and offers to sell you his share for pennies on the dollar. An owner is not swayed by Mr. Market's moods. He knows the true value of his business. He is happy to ignore the manic partner on most days, but he is ready to take advantage of him when he becomes particularly irrational. This mental model, viewing the stock market as a moody business partner rather than an all-knowing oracle, is the key to maintaining your sanity and conviction through the inevitable volatility. How do you cultivate this profound owner's mindset in your own investing? It requires a deliberate shift in your process, a new set of rules for engagement. Here is the blueprint for transforming yourself from a stock renter into a business owner. First, before buying a single share of a company, you must apply the private buyer test. Ask yourself two questions. 1. If I had enough money, would I buy this entire company at its current total market capitalization? 2. Would I be happy to own this business if the stock market were to shut down for the next 10 years? If the answer to either of these questions is no, do not buy the stock. This test forces you to evaluate the investment as a long-term business proposition, completely divorced from the short-term sentiment of the stock market. Second, You must become a student of the business by reading its primary source documents. Commit to reading the last 5 years of a company's annual reports before you invest. Pay special attention to the chairman or CEO's letter to shareholders at the beginning. Does the CEO talk like a partner, openly discussing the business's challenges and triumphs? Or do they talk like a promoter, using jargon and hype to paint an unrealistically rosy picture? The annual report is the owner's manual for your business. Reading it is non-negotiable. Third, you must learn to analyze the 4 economic moats. A durable competitive advantage, or moat, is what protects a business's profits from competitors. You must be able to identify its source. Is it an intangible asset, like the powerful brand name of Coca-Cola? Is it high switching costs, like the hassle of a business changing its core accounting software? Is it a network effect, where the service becomes more valuable as more people use it, like Facebook or Visa? Or is it a cost advantage, like Geico's low-cost insurance model? A business without a deep and wide moat is a castle built on sand, vulnerable to the first serious attack. Finally, after you buy, your focus must shift from the stock price to the underlying business performance. Instead of checking the stock quote every day, spend that time once a quarter reviewing the company's earnings report. Is revenue growing? Are profit margins stable or expanding? Is the company generating a high return on its invested capital? The stock price is just the market's temporary, and often wrong, opinion about the business. The business's actual performance is the reality. As an owner, you must learn to focus on the reality, not the opinion. Following this blueprint will fundamentally change your relationship with your investments. They will cease to be ephemeral, stressful data points and become tangible, long-term partnerships. The antithesis of the owner is the ticker watcher. This person represents the vast majority of market participants. They know the price of everything and the value of nothing. For them, a stock is not a piece of a business. It is a 3- or 4-letter symbol attached to a squiggly line on a screen. Their emotional state is directly tethered to that line. When the line goes up, they feel smart, euphoric, even invincible. When the line goes down, they feel anxious, foolish, and panicky. The ticker watcher has absolutely no connection to the underlying enterprise. They likely couldn't name the company's CEO, describe its main products, or identify its key competitors. Their entire analysis consists of looking at a price chart and listening to the opinions of television commentators. Because they lack the anchor of an owner's mindset, their conviction is paper-thin. A scary headline, a negative news story, or a sudden 10% market downturn is enough to completely shatter their confidence. They don't have the deep knowledge of the business to assess whether the news is a temporary hiccup or a serious threat. All they know is that the squiggly line is going down, and the pain of loss aversion is kicking in. So they sell. They are perpetually renting stocks, never truly owning them. They are tenants in the house of capitalism, paying rent to the long-term owners in the form of poorly timed trades and realized losses. This mindset makes a concentrated portfolio impossible. How could you possibly put 20 or 30% of your net worth into a single ticker symbol whose daily fluctuations dictate your mood? You couldn't. It would be an emotional roller coaster. The only way to have the fortitude to make a large, concentrated bet is to anchor yourself to the bedrock of the business itself. The ticker watcher is adrift on the stormy seas of market sentiment, while the owner is safely on shore, watching the storm with the calm assurance that his well-built house will stand. The direct financial connection of adopting an owner's mindset is the final, crucial link in building a strategy for life-changing wealth. It is the mindset that unlocks the full power of the other pillars. First, it naturally leads to extremely long holding periods. When you think of yourself as a part owner of a great business, your default action is to hold on, as long as the business remains great. This allows the magic of compounding to work its wonders, uninterrupted by unnecessary trading. The greatest fortunes are not made by buying and selling, but by buying and holding. The owner's mindset makes this possible. Second, as we've noted, this long-term approach has enormous tax advantages. By deferring capital gains for years or even decades, you allow your entire pre-tax investment to continue growing. This is a massive and often underestimated source of superior long-term returns. It's a structural advantage that the ticker watcher, with their constant churning, completely forfeits. Third, and most importantly, the owner's mindset provides the psychological conviction necessary to weather market storms. When you own a piece of a phenomenal, well-understood business that you bought with a margin of safety, a 30% or even 50% drop in the stock price during a market crash is not a catastrophe. It's a fire sale. It is Mr. Market offering you the chance to increase your ownership stake in your wonderful business at a ridiculously cheap price. The owner sees a market crash as the opportunity of a lifetime. The ticker watcher sees it as the end of the world. This is the moment where fortunes are made or lost. The courage to buy when there is blood in the streets comes directly from the deep bedrock conviction of an owner. This mindset directly translates to superior capital allocation. It ensures that your portfolio is not a random collection of speculative bets, but a thoughtfully curated collection of high-quality business assets. This is the essence of professional wealth management and a true CEO mindset. You are not a gambler. You are the CEO of your own personal holding company, allocating capital to the most promising enterprises for the long haul. We have now assembled the 4 key pillars of the intellectual framework. Define your circle of competence, demand a margin of safety, practice patient inactivity, and adopt the mindset of an owner. But there is one final, overarching pillar that binds them all together. It is the execution engine. It is the raw courage to act when the time is right. This is the 5th pillar, overcoming psychological sabotage. You can have the most brilliant analytical framework in the world, but if you are paralyzed by fear or seduced by greed at the critical moment, it is all worthless. The final step is mastering your own psychology, a battle that is fought not in the market, but within your own mind. There is no greater example of this than Warren Buffett's actions at the absolute nadir of the 2008 financial crisis. On October 16, 2008, he published an op-ed in the New York Times. The title was "Buy American, I Am." Let's absorb the context. This was not a calm, orderly market. This was a full-blown, terrifying financial meltdown. Lehman Brothers had vaporized a month earlier. AIG, the world's largest insurer, had been bailed out. The stock market was in an uncontrolled, gut-wrenching freefall. The consensus on Wall Street and Main Street was that we were staring into the abyss of a second Great Depression. The fear was absolute, tangible, and universal. And in that moment of maximum pessimism, Warren Buffett, the most respected investor in the world, went public. He wrote, and I quote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful." He went on to explain that he was moving his personal funds out of safe government bonds and into American stocks. He was not calling a bottom. He explicitly said the market would likely go lower. But he was making a clear, powerful, concentrated bet on the long-term future of American business. He knew that the great businesses of the country were on sale at prices that made no sense. Prices that reflected only terror, not long-term reality. This was not a theoretical exercise. This was him, in real time, with his own money, executing his philosophy on the world's biggest stage at the moment of greatest pressure. It was the ultimate act of courage, born not of reckless bravado, but of a lifetime of disciplined, rational thought. He was able to do this because his framework was stronger than his fear. He was acting as the rational owner when everyone else was acting as a terrified ticker watcher. That single act, that willingness to bet big when the chips were down, was the culmination of everything we have discussed. What Buffett demonstrated in that moment was the mastery over the most powerful psychological force in all of markets: herd behavior. Also known as social proof. This is our deep-seated instinct as social animals to find safety in numbers. When the herd is running in one direction, our primal brain screams at us to run with them. It feels safe. It feels right. To stand still, or worse, to run in the opposite direction, feels terrifyingly dangerous. It isolates you. It opens you up to ridicule and the terrifying possibility that you are wrong and the entire world is right. During a market bubble, the herd is stampeding with greed. Everyone you know is making easy money. Stories of overnight millionaires are everywhere. The pressure to join in, to not be left behind, is immense. To sit on the sidelines holding cash, as Buffett did in the late 90s, requires immense psychological strength. During a market crash, the herd is stampeding with fear. The news is apocalyptic. Everyone is selling. Your friends, your family, the experts on TV. They are all telling you to get out before you lose everything. The pressure to sell, to join the herd in its flight to safety, is almost unbearable. To stand your ground and start buying, as Buffett did in 2008, requires a level of conviction and courage that is almost superhuman. This is the great fear and greed cycle, and it is the engine of the market's irrationality. The 99% are perpetual victims of this cycle. They are the herd. They buy from the optimists at the top, and they sell to the realists at the bottom. Their portfolio's performance is a tragic mirror image of what it should be. Buffett's entire career is a testament to his ability to detach himself from the emotional current of the herd. His temperament is his greatest asset, even more so than his intellect. He has cultivated the ability to think independently and to act on that thought, even when it means standing completely alone. The courage to execute a concentrated investing strategy is, at its core, the courage to be a contrarian, to stand apart from the stampeding herd and trust your own rational framework when all the world is telling you you're a fool. This final, crucial skill of psychological mastery is not something you are born with. It is something you build, a mental fortress you construct brick by brick. This is the blueprint for developing the courage to act. First, you must create a written investment policy statement, or IPS. This is your personal investment constitution. Before you invest a single dollar, you write down your goals, your philosophy, e.g., concentrated, value-based, your asset allocation, and most importantly, your pre-committed rules of engagement for a crisis. For example, if the S&P 500 falls by 20% from its peak, I will deploy 1/3 of my cash reserves into my watchlist stocks. If it falls 40%, I will deploy the remainder. You sign and date this document when you are calm and rational. Then, when a crisis hits and your brain is flooded with fear-inducing cortisol, you don't have to think. You just have to execute your pre-agreed plan. Your rational self from the past is protecting your emotional self in the present. Second, apply the contrarian litmus test to every potential major investment. Ask yourself, what is the widely held consensus view on this stock or industry, and what is my specific, evidence-based reason for believing the consensus is wrong? If you cannot clearly articulate a differentiated view, you do not have a truly high-conviction idea. You are likely just following a popular trend. True contrarianism isn't just doing the opposite of the crowd. It's having a superior analytical framework that allows you to see what the crowd is missing. Third, you must go on an information diet. Drastically reduce your consumption of daily financial news. Stop watching the market cheerleader channels. Stop reading sensationalist headlines. Most of it is noise, not signal. It is entertainment designed to provoke an emotional response and trigger your action bias. Instead, dedicate your reading time to primary sources, company annual reports, industry trade journals, and timeless books on business and investing. You want to be an analyst, not an audience member. Finally, find a, quote, rationality partner. This is your Charlie Munger. Find a trusted, intelligent, and level-headed person in your life with whom you can discuss your big investment ideas. Their role is not to cheer you on, but to be your designated devil's advocate. Their job is to attack your thesis, to find the weak points, to force you to defend your logic. If your idea can withstand this rigorous, friendly assault, your conviction will be forged in fire. If it crumbles, you have just been saved from a potentially costly mistake. This system is your psychological armor. It is the training regimen that prepares you to step onto the battlefield of the market and execute your strategy with the calm, decisive courage of a professional. The path of the 99%, the consensus investor, is the antithesis of this psychological fortitude. They do not have an independent framework. Their framework is the opinion of others. They feel comfortable and safe only when their actions are validated by the crowd. They buy a stock because it's a media darling, their neighbor is bragging about it, and a famous analyst just recommended it. This feeling of social proof is intoxicating, but it is a trap. Because their conviction is borrowed from the crowd, it evaporates the moment the crowd turns. The consensus investor is always the last to buy at the top and the first to sell at the bottom. They are caught in a perpetual whipsaw, their emotions and their portfolio dictated by the manic-depressive swings of popular opinion. They look for comfort in their investments, but the only time an investment feels truly comfortable to the consensus is at the point of maximum risk, at the peak of a bubble. And the investments that feel the most uncomfortable, the most terrifying, are often the ones that present the point of maximum opportunity at the bottom of a crash. The consensus investor is engaged in a strategy that is perfectly designed to underperform. They are the fuel for the market's excesses, the providers of liquidity to the patient contrarians. They are the fearful masses from whom the greedy contrarian buys, and the greedy masses to whom the fearful contrarian sells. Their financial journey is one of frustration and regret, a constant reminder of the high cost of outsourcing your thinking and surrendering to the psychology of the herd. They lack the courage to stand alone, and in the world of investing, the crowd is almost always wrong at the moments that matter most. The direct financial connection of mastering your own psychology is, quite simply, everything. Without this final pillar, the other four are just an academic theory. The courage to act is what turns a well-researched, high-conviction idea into actual, realized capital gains. The financial advantage is staggering. It is the ability to deploy significant capital at generational buying opportunities, the 1974s, the 1987s, the 2008s of the world, that generates the 10x, 20x, or even 100x returns that create true, life-changing wealth. These opportunities are rare, and they are always accompanied by overwhelming fear. Only those who have mastered their own psychological sabotage can seize them. This is the ultimate expression of the CEO mindset. A CEO is not paid to follow the consensus. They are paid to make difficult, sometimes unpopular executive decisions based on a sound analysis of the facts, especially when under extreme pressure. As the CEO of your own capital, you must do the same. This ability to execute a rational strategy in an irrational environment is the final and most powerful amplifier of returns. It's what separates the dabblers from the masters, the amateurs from the professionals. It's what turns a sound portfolio strategy into a powerful engine of financial freedom. It is the final promise of intelligent concentration, the transformation not just of your portfolio, but of your own mind, from a reactor to an actor, from a victim of the market's moods to a master of your own financial destiny. You have just been given a powerful mental toolkit. A 5-part framework for building the kind of wealth that the financial industry tells you is impossible for the average person. You've learned to define your circle of competence, to demand a margin of safety, to practice patient inactivity, to think like an owner, and to master the psychological demons that sabotage most investors. You now possess the blueprint for how to make large, concentrated bets when the odds are monumentally in your favor. This is a profound and rare piece of knowledge, and by investing your time to acquire it, you have already separated yourself from the 99%. But this framework, as powerful as it is only one half of the equation. It is the strategic map. It tells you how to think, when to wait, and when to strike. But it does not tell you what to strike. The most critical component of this entire system is the ability to analyze the business itself, to look at a company and understand, on a deep, fundamental level, whether it is truly a wonderful enterprise capable of compounding your capital for decades to come. Knowing how to bet is worthless if you don't know how to evaluate the horse. The video that is now on your screen is the other half of this equation. It is the next piece of the map. It is the microscope that will allow you to examine the fat pitch you have just learned how to patiently wait for. It is the link that connects the grand strategy you have just mastered to the granular, on-the-ground analysis required to execute it. The journey of a serious investor, of a true capital allocator, is a process of assembling a complete mental arsenal. You have just forged the shield. The next step is to forge the sword. The choice is yours. Are you content to be a strategist with no weapons? Or will you continue your ascent and become the complete investor you were meant to be? Click the video and complete your arsenal.